back, guys. So let's dive into the actual basics of fundraising and creating a killer pitch deck. Till last session, we discussed more about how the entire ecosystem works. Today, we will be talking about the fundraising part, and so today we will be basically talking more about how investors work and what fundraising ecosystem is all about. As already mentioned yesterday, that the entire startup ecosystem is a huge machine which have a lot of moving parts. So let's discuss some of the parts which is like the most important part of the startup ecosystem. It is more like the heart of the startup ecosystem, which gives all the energy that is required to move forward, and that is the fundraising. So let's now dissect fundraising ecosystem more and talk more about how fundraising ecosystem works and how it is taking startup ecosystem further. So the first slide that you are seeing out here is all about who these investors are and why they invest money into startup ecosystem. It is a really important question, because why even anybody will be bothered to invest money into a dream of somebody else. These investors are investing just on a promise of the founders and nothing else. I am not sure how many of you are aware of the term reverse engineering. It was made quite popular by Steve Jobs, who was the... I don't need to give any introduction to Steve Jobs. I guess everybody knows here. So he started this technique where he used to come up with a final product and then used to take one step backward and then come to a place where he meets where his product meets the actual problem and solves it. So we will try to decode the funding. We will try to decode the funding ecosystem in the same way. So we will be moving forward, and we will, in process of moving forward, we will be trying to understand each and every stakeholder involved in the funding process one by one. Then only we will be taking. Then only we will be able to take up this big giant. So who actually are these investors, and why the hell they invest into startups? To understand this segment, let us first try to understand the type of investments which goes into the startup while raising a startup. Okay, so broadly, investments are divided into three main categories. First will be the 3 F's. Second is the angel investment, and third is the venture capitalist firms when they come into the consideration. What is 3 F's? It will be a bit funny, and generally there are 2 F's which is known into the industry, but in India we have added another F into the entire procedure of raising fund for the first time. It is called family, friends, and fools. So it can be anybody. It can be your mom, it can be your dad, it can be your chachu, it can be your tau, it can be your didi, it can be your jija, it can be your neighbor, it can be your colleague, or even ex-boss. Whenever you decide to start with your own venture, these are the people who are closest to you, and these are the people who already have that trust part onto you and faith into your decision making. So these are the first line of investors who will be going to invest into a startup. 99% of time, these are the first set of investors who invest into your venture or into your dream. So before going to angel round or before going to VCs directly, try to explore this option also. Now let's talk a bit about angel investors. So angel investor is a community, you can say. Angel investors are a completely different breed, which is most commonly found on LinkedIn bios. You can say that every other person on LinkedIn is an angel investor. So what is the reality, and who are these angel investors actually are? So angel investors are investors, you can say, which are like, so angel investors are basically HINs. HINs are high income nationals. They can be anybody. They can be an NRI, they can be a successful businessman, they can be somebody who just inherited a lot of money from their ancestors. So if they are high income national, they already tasted the success, they already have the money, so why they want to invest it further into the startup ecosystem, which is so dynamic and at the same time so risky? Reason, if they are going to place their money into banks, they are going to get something around 6 to 8% of interest annually. In India, if it is in US, it is not going to be more than 1%, as per my understanding. So what they do, they invest into startups. So in startups, they are going to generally get a return of anything between 16% to 18% to 25%. That is the average. There are other numbers also, but I think they are numbers only, and they are like 1 into million, which we see into, which we read into your story and Inc 42. So that's why instead of keeping money into a bank with some interest rate, single-digit interest rate, or keeping it in the form of FDs, or keeping it in the form of gold reserves, or investing into property, they would like to invest into startups. So this is how angel investors work. Do they invest directly? No. Considering the risk involved and the lack of knowledge of the domain, they generally choose angel networks. These angel networks are generally pool of investors, and the people who are running these angel networks work as scouting managers for the investor into their pool. They scout startup, they do the first review of the startup, their business plans and everything. They conduct an initial due diligence of these startups, and then further, when they are satisfied on the market potential of the startup, on the prospect of the startup, they further place the deal in front of the investors into their pool. So how does these angel networks survive? So they have a revenue model where they charge a fixed amount from the investors on coming into their pool and maintaining their portfolio. Then for every deal which is done by them, that is suppose a startup is getting funded from them, they charge a certain amount from the total amount of investment that the startup just got from the investor. What they call it as a success fee. So it is anything between 2 to 4% as per the industry rates. So if an angel network is reaching out to you and they are saying that they are going to charge success fee for it, it is quite common. So nothing to get worried about and think that they are like a middleman into working with the investors. And apart from success fee, they also charge certain amount of stake into your startup. It is also common, but it should be in single digit, and it need to be under 5%. Sorry, it need to be under 5%. So you need to be aware of that, and you shouldn't be giving more stakes as well as more success fee to the angel investors. A lot of middlemen and a lot of investment pimps have already surfaced into the ecosystem, and they also ask startups to give them an upfront money for their due diligence, which will be like something like 1% of the 5.5% of their total investment, and also it is not how it works. Yes, they do charge some money upfront, but the amount need to be less, because generally the startups which are reaching out to these angel investors are the bootstrapped startups which are raising fund for the first time. So they might be facing the cash crunch out there. At times these networks charge some monthly amount for making the startup investment ready. You need to assess the amount that they are asking and what is the reputation of that startup network into the industry when you are going to get into such programs of angel networks. So just be a bit vigilant out there and take your take an intelligent calculated decision out there. Okay, so this is really poor me. I have recorded the entire video and just now find out that the mic was not connected, so I'm recording it again. Okay, so now let's talk about the big boys of the investment ecosystem. Who are these big boys? Okay, so these are the venture capitalists, popularly known as VCs. They are also called GPs, which is like the short form of general partners. Why they are called general partners? Because they are, okay, to define it, let me define it in another way. Rather than getting it more confusing, let me define it in a completely other way. So GPs or the venture capitalist firms, they are institutions. They are just fund managers. So if they are fund managers, whose fund are they managing? It is a very important question. They manages the fund of limited partners, what we call LPs. What are LPs? LPs are generally institutions who have huge amount of money, and they give these VCs or the GPs to manage them. They can be like big corporate houses, they can be business houses, it can be like a family fund, it can be something like a I'm just taking an example. I don't know in India whether these government institutions participate into providing money to VCs or not. But in other countries, even in European countries, government institutions like Provident Fund and government insurance institutions, they provide money to VCs and GPs to manage their fund and to give them a return on it. As these these institutions like Provident Fund and the other institution, government institution, they have a huge amount of money parked into their bank, which are giving them just interest of somewhere between 5 to 6% maximum, and they also need to pay some interest to the people whose money are with them. So they need to circulate this money and to generate some revenue from these money. So that's why these institutions also give money to the VCs. Okay, so now we understand from where these VCs gets money. It is a risky thing, because when we talk about VCs raising money from family funds, so recently SoftBank raised somewhere around $1 trillion into I think 30 seconds. Yeah, so that it was into news. So he spoke to the Saudi prince, and within 30 seconds he made him agree on an amount of $1 trillion, which he is putting into SoftBank, and from there SoftBank is going to distribute it among the startups which SoftBank is going to fund. And they have raised from the same Saudi prince who was responsible for the killing of a US journalist into another company's embassy, and Trump was unable to do anything. So this is how risky the business of VCs are. They are involved with such and such people. They are involved in governments. Suppose a VC firm raises money from government of China and he was unable to give the return that he had promised. Just think what the Chinese government is going to do to them. So okay, and how they get money? They get money, they go to LPs with the business proposal where they guarantee that okay, they are going to get them a return of like X number of time on the money that they are going to invest, or percentage, like we are going to give you an year-on-year interest of like interest increase of somewhere around 20 to 25%. That is like the average. When we talk about investment and 20 to 27%, that is like the what we call the ballpark number, and the average that generally comes with the investment into startups. They start funding from the seed rounds. A lot of entrepreneurs make mistake of going directly to VCs for first round of their funding, that is angel round. They don't invest at angel round. They invest more when the entire structure of your venture is ready and you have started generating some revenue, and you are having some year-on-year growth. Then only VCs come and invest into their companies, into your company. So it is a really bad idea to go directly to VC. In India, there is, due to lack of knowledge, information, whatever there may be. So the day entrepreneurs start up with their venture, they start reaching out to VCs, and they receive rejection after rejection from the VCs. VCs being polite, they will say that okay, at this point of time your venture is not ready for the investment from our side. And what the message which is conveyed to the founders are that their venture is not ready for the investment, but the message here is that their venture is not ready to get funded by the VCs. They can always go to angel investor. Angel investors are angel investors would love to fund your startup if it is getting some traction, and early revenue is like really good, but even if it is getting some good amount of traction, you can easily get funded by an angel investors. One thing that I learned into my entrepreneurship course with Wharton School of Business is that angel investors invest into passionate founders. They generally invest into people. They generally invest into team members. On contrary, VCs, they invest into the strategy, they are going to invest into business plan, they are going to invest into the structure of the organization. They have their own research team which sits there and do a lot of research. They crunch a lot of numbers, and then they will decide whether your startup is fundable or not, or is it investment ready or not. So let's talk a bit about the risk which is also involved into the investment firm. So you will be able to understand the side of the investor, why they shy away so much from investing into new ideas on new ventures. From time to time, we hear stories of investors who have invested into a certain venture and they got somewhere around 330x out from that. To take an example, Artha Ventures put money into OYO Room. They were like their first investors, and the director of Artha Ventures, it is Anirudh Dhamani. So he's a good friend of mine. And so he only told me the story that they got 330x out of from OYO Room in 4.5 years. So they invested somewhere around 8 CR into it, and they got back somewhere around 2,800 crores out from it into 4.5 years. So this is 1 in a billion story. So the average of angel investor getting their returns falls something between 18% to 26% to 27% when it comes to return. So 1 in a billion or 1 in a million, there will be investors of venture who are going to get somewhere around 10x, even 10x return onto their money. One of the reasons I ask early stage entrepreneurs or first time founder not to read too much of your story, funding stories, or Inc42 funding stories. Even I ask my team member to stop publishing them. We at Startup Monk is also having a media section into a media domain into Startup Monk. So I ask them to stop publishing funding story into the editorial section of Startup Monk. These stories of funding and everything, and investor making a lot of money out of their investment is going to is giving false hope to the entrepreneurs also. It is not only giving false hope to the investor community, but it is also giving false hope to the entrepreneur. But it is also giving false hope to the founders, because they think that they can easily get money out of investors because investors are making so much of return out of it. It is not the case. And it has been proved. There is a research which was done into UK, and I have the data of the research also. And it is a published research, so it is not what you can say a cooked up report, which we can see in a lot of Indian newspaper and the news channel. So it is like a real good work of gathering data and research. So I will just briefly go through the points which is there into the report. And so the research was conducted by Dr. Weltbank. It was funded by Kaufman Foundation. You can go and check. Kaufman Foundation is a really good foundation. And it was conducted in the UK, NESTA UK. So the point into the report here, if angel investors is investing into only one startup, 100% of time it is going to fail. After exceeding 6 investments, suppose you are an angel investor, you need to invest into a lot of startups. So after investing in 6 startups only, they are going to break even. So if they are putting like 10 lakhs into 6 startups, they are going to get 60 lakhs from one startup, and the rest are going to fail. The next point is that the maximum return that is investor can get is after putting money into 50 startups at an interest of, you can say at an interest of year-on-year interest of 27%. So just think about the perception that we have that investors are making a lot of money. So after investing in 50 startups, they are going to get a year-on-year interest of somewhere around 27% on that. That is the maximum return that any startup has. That is the maximum return that any investors has got till date. So next point is really good. 90% of the results are concentrated in 10% of the startup, which means that if you are going to invest into 10 startups, 9 startup is going to give you only 10% of the returns, and the rest 10%, that is the one startup, is going to give you the 90% of the return. So just think of the percentage of failure of the startup even after funding. The next point is really good. It is really good for the founders or the entrepreneurs who are looking to raise fund into the near future. 85% of the angel investors in the study were entrepreneurs who previously had cashed out on a company, which means if there is an investor who was previously an entrepreneur and he just sold his company, or his company got acquired, or his company got merged, the chances of him investing into your venture is 85% more than anybody else. So out of every 100 investment, 85 investment are done by the entrepreneurs who just cash out or sold, got acquired or merged with another company. So to take an example, in India, when Kunal Saab just sold his company Free Recharge to Snapdeal for somewhere around $390 million. Till day I am unable to understand how he was managed to sell that company, to sell a app like Free Recharge for $390 million. And funnily, after the acquisition, Snapdeal sold the same Free Recharge to Axis Bank for 228 crores. So just see the difference, $390 million to 228 crores. So it was something which Kunal, I really admire him for how he sold the Free Recharge for so much money to Snapdeal. How he screwed the entire Snapdeal progress and everything. Okay, so back to the topic. When Kunal Saab sold his Free Recharge, he invested in almost 20 startups after that. So he had the money, he started investing into startups. Right now, in the current scenario, Ritesh Malik, Dr. Ritesh Malik, who just sold his Innovate to Oyo Rooms in the form of Oyo Workspace, he is investing in a lot of startup as of now. He's like putting in money into this startup, into that startup, into some other startup. Binny Bansal is putting a lot of money. Binny Bansal, then Sachin Bansal has committed almost like $90 million out of his $100 billion, $1 billion. He has committed somewhere around $900 million for investing back into the startup ecosystem. So these are some of the figures, and 85% of chance of you getting funding is from the entrepreneurs who just sold their company, got acquired or merged, or anything. You can say they just cashed out from their ventures. So 85% of chances are from getting fund from these ventures. After 4 years, if it is a successful investment, after 4 years, the investors are going to get a return of 2.6 times. So for those 4 years, their money will be parked into the startup, and they are going to get 2.6 times after the 4 year if there will be an exit. And how these exit works, I will briefly touch into the next video how this exit works, and how it affects the startups and everything. As we are not having that much time into the entire 5-day course, I won't be able to discuss in length about it, but I will try to. But I would like to briefly take that discussion also into the coming classes, or you can say into the coming courses. So, and the last one is 9 out of 10 venture-backed startup fails. When I say venture-backed startup, these are the startups which are backed by venture capitalists. When I talk about venture capitalists, so they might have taken some money from a family fund, like from the Saudi prince. So if you are 9 out of 10 startup of money of Saudi prince is failing, just think what he is going to do to you. So it is just the risk which is involved into the entire investment ecosystem, which makes it hard to get money. And in case of India, it is also the trust factor which is not there, which is also hampering the startup ecosystem a lot. Because in past there are startups who have cooked up their balance sheet and everything through bank and all. They did a lot of jol-jal and raised money from the foreign investors, and then it really killed the venture and the trust also of people investing into India. So a lot of factors like that are also there. Oh God, I am sweating like big. So with all the risks that I just mentioned, if our investors agrees to invest into your startup or your venture, be ready. Be ready to give control to him, because if he is going to put money into your startup, he is going to get, he's trying to control his money as much as he can, and which is like logical also, because he is betting on somebody else's money. He also have to give the return to them. So it is logical that he will be taking control. How he takes control? He takes control in the form of voting rights. He takes control in the form of terms like, you are going to hear a lot about it if you are raising startups like LickPref, which is like liquidation preference. You will be hearing words like tag along. You will be hearing words like drag along. Then these are some of the words. This is how they take control over these startups and onto their money. They just want to protect their money, and they just want to protect their money, but the message goes across to the startup ecosystem that they are the evil people out there, and they want to control the startup, and they after some time they are going to remove the founders and everything. But it is not like that. Every decision which was made by even firing of Steve Jobs, even firing of Elon Musk from PayPal as the CEO, everything was every decision was taken considering the interest of the venture in which these investors have invested the money. To take a simple example, our parents put money into our education and everything. That's why every day at 6 in the evening, we were like dragged back to the house, and they asked us to open our books and to study rather than playing outside with the colony kids. And being on the investor side of the ecosystem, I feel it is quite logical also, because the venture, the startup, it is not dream of an investor. They are just investing on the promise which is committed by a founder that they will get a return. They are going to get a good return in the futures. It is not their dream also. And trust me when I'm saying this, in startup ecosystem, nobody knows anything. Nobody knows that which company is going to succeed and which idea is going to succeed, which idea is going to have a good market potential. Nobody knows anything. We just take intellectual, we just we just have intellectual guesses. That's all. When it comes to success of a startup, the data, the research, nothing works. It is all the market which drives the success of the venture, and market is really brutal. It doesn't matter. It doesn't matter whether founder is from IIT or IIM. It doesn't matter to the market whether the person is going through a depression. It doesn't matter that it doesn't matter to market whether the person is unable to take salary for the last 5 months. It doesn't matter to it even doesn't matter to the market that there is a death in the family of the founder. It doesn't matter to the market if you are going through a breakup or you are going through a divorce. It doesn't matter to the market that you are missing. It doesn't matter to the market that you are unable to see your kid for last 1 week. It doesn't matter. Market is simply really brutal. So after all the demotivating thing and the fearful thing which is there into this investment ecosystem, let's talk something about which is going to motivate you and which is going to take you back to investors' door again and again, and to knock them again and again, and to provide and to give them your pitch again and again. The part which I am going to tell you now is really important for first-time founders and the early-stage entrepreneurs, as it is something which keeps them going again and again and moving forward. First, you need to understand that investors are not into the business of raising startup. They don't know how to raise startup. I will repeat again, they are not into the business of startup. They are in the business of entering and exiting. That's all. They put money and then they take back the money with certain X number of times of the profit. This is what investors do. They are least bothered about your startup. They only care about your money. So you need to understand this. Said that, we people, when we raise a venture or we create a startup, what we come up with a product, we come up with a services, we come up with a process, we come up with something which we sell and we get money from it. So this is what really a business is. For investors, their product, their commodity is money. They deal in money. They deal in the commodity in which they deal is money. So they sell money to get more money. This is the entire business model of an investor. So so if you have a business model where you have to sell your money to get more money, what you are going to do? You need to sustain the market, the competitive market which is there into the investment ecosystem also. You need to generate some profits. So how you are going to generate profits? For that you need to create revenues. How you are going to create revenues? By selling more to the consumers. So who are consumer in this case? Startup founders are the consumer in this case. So investors need to sell their money to the startup founders so that they take their money, and then when they will be exiting the entire system, they will be exiting with certain amount of X number of times. So this is the entire business model and revenue model of investors, and they are forced to invest into startups. So if they are not investing into startups, then it will be really hard for them to sustain. So they need to make sales in the form of more investments. This is something which all founders and entrepreneurs should know, that they are not only in need of the fund from the investors, even fund need good startup from the startup ecosystem. Said that, your job is to bring a good product and a good business plan in front of the investors. If they find it good, they are going to invest into it. You have you have only two jobs to do. One is a good product and another is a good business plan. That's all. That is only thing which angel investors look for. I said that you need to create a good product, you need to create a good business plan, and the investor is going to invest into your startup. You will be really surprised that investor have scouting managers like people who go into the, like, business plan competition, investor pitches, and then the founders meet and all, and there they look out for startups which are like have some market potential and can grow into the future. So they just exchange cards there. After that, they start following up, like we receive call from the customer, from the telesales executive. So these founders, these scouting managers also gets after the life of founders just to give them money. Okay, guys, take our money and let us be your investors. So this is how the startup ecosystem works. So I think I am done for today, and I think it is enough of Gyan for one day, and let me wrap it up now. And I think it is enough of Gyan for one day, and there will be a lot of questions which will be there into your minds, which you can go and ask. We will be taking the Q&A session tomorrow, and there I will be answering the question which will be related to anything that we have discussed today. So today we discussed about the funding ecosystem. We talked about the type of investment. We talked about the type of investors. We talked a bit about why they fear, how much risk is there into investment, and why the percentage of investment is really low, why they shy away from investing into a startup which they are unable to understand, even if the startup is working on a good idea. Okay, so that's it. I think we are done for the day. Tomorrow there will be a Q&A session at 9, and we are going to, and I believe that you all are going to have a lot of questions regarding this, and I have to answer a lot. I need to be prepared for that also. And apart from that, tomorrow I will be releasing the video after the Q&A session that will be talking about more about the framework of, is your startup ready for the investment or not, and on what dimensions we judge whether a startup is right for the investment or not, and how we judge their valuation. Because the most important thing for any startup or anything, the most important thing in the pitch deck is your valuation, because valuation is the part which really pisses off the investors. If you valued your company at like 8 crore rupees and your revenue is only like 500 rupees in the last 20 days, then it is like really bad valuation. So we will talk about that we will talk about that briefly into tomorrow's video. And let's take it further. I am really amazed. I am really excited for taking it up. For tomorrow, there is also an assignment which you all need to do. It is not for us. It will be for you. It will be help you to better understand your readability of the investment, whether your startup is ready or not. So tune in, and we are going to have a Q&A session tomorrow. Then we are going to have the then we are going to have a Q&A session. Then we are going to have we are going to release the video also. So yes, till then, bye. See you all. Bye.